Hello and welcome to episode 21 of Mortgage Mythbusters.
What is it? Welcome back. First of all, is it 21 or 20?
100% 21. We don't even have to worry about that. That's the easy bit today. We've had
Right.
some technical issues. I'm going to be in a lot of trouble off Barry when we finish this pod, and our guest has disappeared.
Yep.
Because he asked if we were prepared, and nothing was prepared. It was, but it just all decided to jump out and cause us some dramas.
So I'll
But
be
we're here.
charging tech support fees today, which is good.
Yeah, about 24 hours
Extra.
delay. We've had to put our guest up in a hotel just to keep him here, so we didn't miss the opportunity. But
Yep.
we're here and we're going. So here we are. So before we get started on episode 21, we'll just touch very briefly on what was the first part of a new season of podcasts that we're...
So episode 21, but it's not. It's season 2, episode 1.
That would
This is
really
episode
complicate
2.
things,
I know, this
especially
is
when
what I
we're
mean.
using
Right,
Roman
we'll sort out
numerals.
that before the next podcast.
We definitely shouldn't have used Roman numerals, as we've built in the last week. We've built a Facebook page, an Instagram page, a LinkedIn page for the Mortgage Mythbusters.
Yeah.
And Roman numerals are not kind into post, or into putting anything in an ascending order, believe it or not.
Well, listening back to last episode when I was editing it, and straight away you dig into how bad I am with Roman numerals and how I totally got it wrong on there. It was embarrassing. So
Did you
I'd
cut it
rather
out?
No, I should have
You
cut
left
it
it
out.
in. I
Really.
like
I
that,
left
mate.
it
That's
in.
some
Warts and all.
transparency. So the myth last week, which was first part of the new season, which we're bringing guests in, specialists, lenders, packages, building societies, banks, and that was with Tom from Build Loan. It caused domestic issues with Alice.
Yeah, good.
That was great.
Hi, Alice.
Hi.
It got everyone's cogs turning. Everyone went home and decided to rip the roof off the house and put a few extensions on.
Yep.
Barry's now trying for another set of twins and triplets,
Yep.
I believe. Now he has the room to do that, and the space and ability, as we learned from speaking to Tom. Then it opened up a few podcasts, and I'm looking forward to Tom coming back, because we brought another 3 myths into the equation, didn't we?
Yeah, it's interesting.
What were
Really
your
good.
thoughts on it, Baz?
I think with doing all these podcasts, which have been sort of generally on normal mortgages, if you would sort of term them that way,
Absolutely.
it's been the whole thing that we're focused on is like you need a deposit to put down, then you need to see if you can afford the monthly payments, then it's about the rates. And no matter what we've touched on, it's always been that process. Whereas with this, it's totally different because you're having to get the funding and stuff for your planning and all the things beforehand, architects and all that kind of, and the way Tom went into it about the 3 stages that you could use and things, and it was very interesting.
It sounded extremely easy. We know it's not, and it was good that he's had the experience of doing it himself.
Yeah, but it was also, he touched on that Grand Designs makes it look really hard, and it's not that hard. So it was good to have a different opinion to what I thought he was going to say. Yeah, it's a nightmare.
Yeah,
but he didn't.
which it does seem to be. I mean, it will. Nothing's easy. No one.
No,
will
but
say
it's
it was
hard
a breeze.
buying a house, isn't it? At the
Yeah,
end of the day,
but it's for a particular type of person as well.
Yeah, of course.
But no, I think it got all our cogs turned. I think it was a very popular podcast because when researching the myth we were going to discuss, there was nothing there.
Yeah.
I think it's one of these where you naively think it's not possible. Why even bother starting? Whereas with a house and a mortgage, you speak to a mortgage advisor, and like you say, route 1, that's what we know and talk about. Very generic income, deposit, job done. But I think, given the stats you give, the 15% versus the 80%, to other countries, phenomenal. That
crazy, isn't it?
Isn't it?
But it was good. First of all, it was good just to have you saying a bit less as well, and you looked a bit baffled by things, which is usually my role. So it was quite good to actually see you learning things on the job as well. It was good.
Yeah,
it's interesting.
Which brings us quite nicely to our next podcast and our next guest.
Yeah.
And we have Stu Bryce from Chorley Building Society. Hi, Stu.
We do.
Hello, everybody.
Hello.
And funny enough, Stu used to work for Build Loan, and he worked with them at the point of me doing the renovation on my property. And I went to see him down in, I want to say it was the Haydock. And you were doing a presentation.
I think it was Bury, wasn't it?
Bury, it was. I had nowhere near Bury. That'll do. And I remember sitting there and my face drained, and I kept asking questions. Not a lot of people do ask questions. They might ask certain ones, but I was having a full on advice session, and the further it went on and the deeper I already was into my project, I remember thinking, I should have been here a year ago.
Yeah.
I remember you saying something along those lines, actually.
It's horrific, but we're not gonna harp on with Bill Loan today. We're gonna touch on Chorley Building Society and Stu.
Yep.
And the myth today is fantastic, and we've actually changed the myth, and we will get Stu back on. And I'm saying that before we've even done this podcast, just because of the other niche things that Chorley bring to the table. But today's myth is you need a high credit score to get a 95% mortgage. You need a high credit score to get a 95% mortgage. I would even say the myth is you need a very high credit score to get a 95% mortgage. And that is the common myth. And people are, in my opinion, obsessed with their Experian, Equifax, TransUnion score, the numbers on there. And that's what we're going to bust today.
Right, so I'm going to jump in straight away. Stu, you all right?
Yes, thank you.
Relaxed?
No.
So, first of all, what's your role at Chorley?
So I'm head of business development at the Chorley Building Society. So my job is to educate mortgage brokers on the wonderful things that we do at the Chorley Building Society.
Okay.
And the way that we can help you to see more opportunities and service more of your customers and help more people get onto the housing ladder.
Very good. So, I'll just pick the bones out of this from what Paddy's just said there then. So, 95% mortgage is obviously you're lending 95% of the value of the property that you want to get, right? But the myth is that you need a high credit score to do that. First thing I think of is deposit not more important?
So they come hand in hand.
Do you see what I mean?
And this one's a good one for you because you want to do a Mythbuster on credit score.
I don't think I've ever done credit score, so I've never done one myself.
The background behind the myth is that
desperate.
A credit score is a score, and it's like you've got a rating on yourself of 999 is the best you can do as an example. And if you wanted a 95% mortgage, which would be the highest risk, because that's
they're lending you that much.
Yeah, other than the niche ones like the Skipton's 100% mortgage and things like that, you need that credit score. And if you don't hit, let's say 799, then no chance. You could be the best payer in the world, but you've moved around a couple of times, lack of credit, like Martin Lewis would say, and what you've got there is no, you can't. Okay. So a lot of people think that they need to wait until that point, whereas the myth we're busting right off the cuff, because we do want to talk a lot about the other niches that they do, is that that's not how Chorley operates, and I'll let Stu explain.
So this is all, just to touch on that then, this is all about your credit rating is basically how reliable you are to pay the money back. That's what
apparently so.
Is that what you'd say the credit rating, the main role of it is?
Yeah, I suppose different lenders will work in different ways. So when you look at your big lenders, those lenders that you would think of, those big banks and building societies that you'd think of for your mortgage, they will generally have an automated system that is scoring you. So actually, when you get probably one of the first myths is when you're looking at Experian, Equifax, TransUnion, and it's giving you a 999 score or a 699 or a 39 or whatever figure it's giving you, doesn't necessarily mean that any lender is going to do it, because any lender will have their own mechanism.
So they in effect have their own credit scoring system.
Yeah.
Right,
So
okay.
what the big lenders will be doing is they'll be looking at various different aspects of your life. So do you live at home? Are you renting? Do you have a mortgage? Do you have any loans, credit cards, catalogues? Are you paying bills on things? Is there anything? Are you on the voters roll? There's lots of different aspects, and each element they'll give a score to.
Okay.
And within your credit file, as people will see their credit files, they'll see their items of credit, and those items of credit will log whether you're paying your payments on time. And ultimately what the lender is doing is seeing whether they're going to get their money back, they're going to get their monthly payment, or whether you're a risk. Okay. Now, allocating a score can be one way of doing that. From a building society point of view, from a smaller building society point of view, we tend to take a more real life approach to that. And actually, it's not about a score, it's about a person. So we'll look at it from a real life point of view.
Right, okay. Right. So I come to you, and what did you say? 799 is a rough figure, you said, didn't you? But that...
You're upset because I've got a higher score than you, so
Yeah.
you think, oh, morale down.
Yeah.
I can't get as good of a mortgage as Paddy. I need a bigger deposit. That would be the myth we're busting.
So what would make me, what would bring not my score up, but my reliability in Chorley's eyes, that I'm going to pay you back? When you say it's judge on the person, I mean, Paddy would say straight away you're not having one, but if you were to judge me fairly...
Yeah, so if you consider all those things that I've just described, if you were constantly making late payments or not paying at all, then that will have a detrimental effect on anything that you do. Whether that's with us or with any other lender, it's still likely to cause you problems. Now, other things that will cause you to have a low score is if you're a first-time buyer, for example,
Okay.
and you're living at home with your parents, you've not got a car loan, you've not got a credit card. So when a lender is looking at your credit profile, they're thinking, how can we be sure that this person is going to be paying us back?
Because there's no history or
no
little
track
history.
record or
Right,
anything.
okay.
Yeah, there's no track record of them paying a mortgage, paying rent, paying a credit card, paying a car loan, paying anything. All that they'll see is that person lives there because they're on the voters roll, and there'll be very little else. You know, there might be bank account details on there, but that's not really going to show any great amount of detail. So that in itself can cause a low score with the big lenders. And you know, you touched
almost certainly,
yeah.
Crazy that, like, to me, is a layman, it's crazy that you have a low credit score because you've not needed to get credit, if you see what I mean.
Absolutely. And one of those things that's frustrated me for many years, because I've been in this industry far too many years, but for a long time, ever since credit scoring really came in, there was that drive for people to get some form of credit just to show that they are creditworthy.
Right, okay.
And even you know, you touched on Martin Lewis. He's absolutely right. Get a decent advisor. They are worth their weight in gold. He'll also give hints and tips on other things. And one of the things that he'll say sometimes is, if you've got a low score, if you're that first time buyer living at home, get a credit card. Spend on the credit card. Make sure you pay it off each month, so you're not being charged interest on it, but it's building your score up. But even that has an element of a science to it, because you know, if you had a £500 limit on it, I can remember him saying this on a show not long ago. Somebody's called in and said, "Well, I did what you said, but I've got a £500 limit. I've spent up to £490 each month. I clear it off every month, and I'm still being declined." And he's saying, that's because you're going right up to your limit. So the lender is then thinking that you're living really close to the edge of your means, and that's having a detrimental effect as well. So just spend half of your budget, half of the limit. So if you've got 500, spend 250.
But who would know that? Like, which normal Joe Blogs would know that there's this little sweet spot? And
but again, with the problem with the credit, I love a credit profile. I can really see into your life with a credit profile. Everyone can, and they do serve a purpose, 100%. Because I suppose technically you do look at their profile, you just don't have a score. Now, with the way that they work, is they're a snapshot, and the lenders have to report to them the facts. So your credit card could be £200 today, but you may have spent up to £150 last month. The previous month could have been 2,000, and it just depends when that snapshot of that report to the Experian, Equifax or TransUnion, whoever they are reporting to, sometimes all of them, it'll give that balance, so it won't always be accurate. And if you are, like Stu said, at 95% of your maximum credit limit,
it looks like you're struggling straight away.
It would also look, to you, it would look poor. What you're saying is that you would go and look at the facts and say, well, let's look at the spending on a bank statement or a statement to see, was that just a one-off? Was it just a quick holiday and they took the snapshot of the credit score and actually the balance is lower, but that was just a one-off, whereas a credit scoring system would use that. And I'll just quickly, just because we can mention other lenders, we're allowed to, and we're doing this factually, because I'm not going to say something that's not true, but Halifax, they have so many perks and reasons why I would put them, a customer with them over another lender. But one thing that they do, and this is still part of their system, is if you put a home telephone number in as well as a mobile, which I don't know mine or even have one, that will give you a higher credit score. Also,
it's the most bizarre thing.
It is, but it's so kind of dinosaur-ish of way of doing it. But what's also dead interesting is I could put me and you on an application. Okay, you could be very tight, never have a credit card in your life, and therefore your credit score would be low.
Yeah.
And then you could have myself, who might have used his credit a lot more, and I've got a 999. If I put you on the application as applicant 1 and me on as applicant 2, and I went for a 95% mortgage, and I'm talking out of many years of experience of doing this, we're encouraged to, if it declines, switch the applicants. So same customers, and that will give you a higher credit score because they
still going 50-50 on the mortgage,
regardless of income. So it's not, normally you would just put the first applicant as the first applicant, the first person you spoke to on your sheet. But when we structure it, and we can flip it, and we'll get a pass. That has happened many a times. And it's encouraged by Halifax to do that. They're just one lender, but when we say high street, and I'm probably saying it's because of volume that they use that type of system, as opposed to a human looking at everyone.
It'll be some computer, so it'll probably be an algorithm.
But that just gives you an idea of, imagine if you are someone who, like yourself, has just saved.
Well, I've to be honest, I'm very late to. What would I have been? 40s when I just turned 40. I would say when I got my first credit card, and it was literally just so we were covered when you're on holiday, and you know, like for that kind of thing, because we've never really.
That's because Sunderland have never been in Europe, and you've never needed to.
Okay, that's the first dig. What can we have a time check on that? So yeah, I'll edit that out. Forget it.
Can I add a little bit?
Yeah, go for it.
So you know what we've just talked about. I mean, you've kind of highlighted why there's a need for a mortgage broker, because there is a little bit of science behind other lenders. From our point of view, as a smaller building society, we maintain our traditional values. So whilst I've talked about how you know, getting a credit card, spend on your credit card, don't spend too much on your credit card, pay it off every month, will help you build a score, it's not the only answer.
No.
You know, so from our point of view, we will do 95% lending, and if somebody is living at home, living with their parents, living within their means, you know, we can see their bank account, we can see that they're well within the, you know, if you're pushing your limits of your overdraft every month, you're not giving yourself a great example. No. But if you know, we can see that they've got money in their account, they're starting to save, etc. We don't mind that they don't have any credit. The reality is, why should an industry like ours be forcing people into having some form of credit that they don't actually need or want, just to prove that they can have some credit that they do want? So from our point of view, if somebody's living at home, living within their means, and their overall profile looks good, we're fine with that.
Just on that, and I'm probably putting you on the spot here, but what can affect the 95%? And this can get, so someone thinks they're doing really well, maybe check their Experian all the time, and they know the 999, but then they've parked at Morrison's for too long, and they've got a parking fine that they weren't aware of, and they'll have that CCJ slapped on for 150 quid or something like that. Or maybe they're disputing it because they were quite within the right to, but the first thing they do is trigger happy, boom, forgot it. That would automatically mean you'd get a decline from, say, Halifax at 95%. We'd then explore it, we'd probably try and appeal it, we're trying to get it removed, and would help the customer. And in the past, we have had customers kind of in the military prove that they weren't aware of this and then paid it and it was removed. Okay, that's very rare, but it can happen, and we do help them. That takes time, not just days. If that happened to you guys, and we had a squeaky clean customer, clearly had saved and done really well, and he had a parking fine on his credit for 150 quid, would that be something that you as a human could see and understand?
Absolutely.
Really?
Yeah, absolutely.
Right,
so you're dead right with those credit scoring systems where it's the computer making the decisions, and it's computer cross-referencing it against a credit file, seeing if there is anything adverse, for want of a better expression, on there that is likely to trigger anything. A countercut judgment, CCJ, as you described, is likely to say, computer said no. From our point of view, we are a real life lender, and we understand that life throws some challenges at us. Sometimes it doesn't make us all bad people, though, does it?
No.
If somebody's inherently not paying things, then would we want to lend to them? Probably not.
No.
But if somebody's that situation that you've just described,
Yeah.
Paddy, where somebody's just got a parking fine, the parking fine might not have caught up with them. It's gone to court. They've got a county court judgment, and they didn't even know about it.
Yeah.
Then we're fine with that. If it's not linked to credit, we can actually do a parking fine for a county court judgment, even if it's not outstanding at the time of, if it's still outstanding at the time of application. They need to settle it before completion,
Of course.
or it needs to be removed one way or the other. But we'll take a common sense human.
We get that a lot
approach
with the
to that.
military. Imagine getting fastballed and told you're leaving in 6 months' time. Probably checking your post if you're single in the military is kind of the last thing you'll be doing. And they can have, it might be a mobile phone,
something that's just
things
missed.
that have been caught them out. Lenders as a whole are very good with the military, and we can explain that. And certainly if we can demonstrate the time in, say, Afghanistan, that these parking fines and things happen, and then they can escalate to a larger amount. That's something that does put a brick wall with the credit score. And there are lenders out there like Kensington who use a similar approach, and they've got the hero range and things like that. But that's great to know that we come to a real life story, you'll listen, because the credit score is computer says no, and we've all heard
Yeah, if it was me myself, I'm looking at getting a mortgage. I come to you. You then process the application with Chorley, but then it red flags at your end then. So then it's saying credit score. I take it that's when it would show up.
So we don't score. So we're not
Sorry,
scoring.
but yeah, but
we
it would
search it. We'll do a credit search. So we'll look at the
search,
profile,
and then
we're not allocating a score to it.
so you see something on there, which I know I can explain to you, and we could, can get past that. What happens then? Would you report back to Paddy, or am I dealing directly with you? How do you get the personal side of it? Do you know what I mean? How do you find all the actual real reason for it? Say it was this thing with the CCJ.
Yeah, well, that's all the world of the mortgage advisors, because what Paddy or any other mortgage advisor will do is a fact finding process.
Okay.
And they'll be asking lots of questions, including, is there anything that I need to know about? Is there anything, any county court judgments, defaults, missed payments on anything?
And if something wasn't reported then, because you'll do your fact find before you send it off, obviously.
We have a chat, then we'll rely on that fact find normally. If they're unsure that there might have been blips, we'll go and get a credit profile check, score.
And what if there is something like that, like if it was someone in the services or whatever, and something showed up once the application had come in?
That just goes to our job of looking at it and then seeing what fits people's criteria.
Okay.
And what we're talking here is that we would know about it at this stage 9 times out of 10. But there are instances where we wouldn't need to get a credit score. It would look brilliant. They might have told us about the CCJ and we'll think, okay, Chorley. And then it might be that Chorley would come back and say, actually, there's something else on there. We've got to be very careful, and we've got a process to deal with this, especially on a joint application. You know, you can cause a lot of trouble within a marriage if you say your application's been declined because of this. What we would do is encourage them to get a credit profile, so they've got a sight of it. They would provide that to us. We'd then look at it and talk to them about it, because it's sensitive. No one likes to have it, and it can cause dramas, especially when you're buying the biggest thing that you're going to buy. So it's one of those where, for all this is the myth we're busting, that itself is a doorway into what would normally be, sorry, the computer says no.
Yeah.
We've done this myth before. Your bank says no.
Mm-hmm. Is that it done?
Yeah. Too many people will go at the bank, can I get a mortgage? No. I'll keep saving, paying rent while I'm saving, so doubling down. Well, actually, if they spoke to a mortgage broker, then that's when we would take the whole picture and decide who we're going with. And that's when we would be looking at someone like Chorley in them instances where we knew if we put a good file together and it met their criteria, so we're talking age, income, affordability, would move it on. And then let's say and passing that to Stu to say, do you want this case at 95% high risk? And we'd hope that we'd put a big enough file to a good enough reason, and that's where we'd get the accept, whereas he may have been knocked back. And we're talking HSBC, Halifax, Santander would all have a scoring system, and that could be 5 lenders down the line that you'd give up, wouldn't you?
So theirs is basically put the numbers in, put the situation in it, and it's done with like algorithms or whatever, I take it. So how's yours? Because yours isn't a scoring system.
Ours is real life people. Yeah.
So literally look at the file that Paddy sends over, read through that with a fine-tooth comb, and then say, well, that looks a bit off, say, but Paddy's explained why it's like that. We've got this evidence for it. I think it's fine. And that and does this mean you've got a lot more hoops to jump through internally to pass things, if you see what I mean? Because basically that computer, these other banks or lenders are probably doing it for you and giving you that safety net as your head's not on the line here. If you're doing it personally, I suppose there's a bit more risk involved, is there? Or?
No, I would argue probably the opposite.
Right?
Me too.
Yeah.
Because you taking a personal view of everything that's there, I suppose, aren't you? You're not just saying that looks bad, we're not doing it.
Yeah. I think different lenders will have different views on things. So the big lenders will be of a certain size where they've got to do a certain amount of lending.
Okay.
So they've created the systems to make it slick.
Mm.
You know,
Yeah.
if you tick all the boxes, you can zip through that machine really quickly and get a mortgage offer really quickly, get the lowest interest rates really quickly and get a mortgage offer and have little or no human intervention. So it helps them do the volumes that they need to be doing, which is obviously a benefit for everybody in the industry. But not everybody ticks the boxes, do they?
No.
There's good people, but they might touch the sides on those systems. And from Paddy's point of view, it's then, if I could just speak to somebody and explain the situation so that we can understand it, so an underwriter can understand it, or the lender can understand it, we can then see if we can find a solution.
Right.
And that's exactly what we do. So Paddy will have a great relationship with our underwriters and be able to say, look, these are the good bits, these are the bits that you might be a bit unsure of, and these are the reasons why I think you should do it. How do you feel about this? Can we progress with this? Can we move it forward? And we'll explain how we can help and how we can do things.
It's almost like a sort of two-pronged attack, haven't you? You've got, as you say, if you're wanting to find these solutions, and then you've got Paddy who's wanting to fight the corner and wanting to give you the right information, and you've got more of a chance.
Yeah, let's face it. Life throws some rubbish at us over,
Of course
over
it does,
time.
Yeah.
And so, if there's a life event that has caused something to happen, you know, that parking fine might have just been an oversight. It might just have, you might just have been at the time when you're moving house, or you're in forces and you've moved around. And actually, the post's gone to one place, you've just moved to somewhere else. It's not caught up with you. Does that make you a bad person?
No.
It probably doesn't, does it? You might have had a marital split and it's caused you to have a few blips on your payments in the past. But a bit of water's gone under the bridge, you've caught up with everything and you're now moving on. Do we need to carry that on? Because a credit file, it lasts for 6 years. So lenders can look at a 6-year period for you.
Because it could be illness or anything, I suppose. That
the richest person in the world with a 999 score could lose their job and could be ill.
Of course. Yeah.
And there is no way to kind of paint that picture, and it would be interesting, and I can almost guarantee, because you're not a dirty lender, you're not looking for adverse credit. We're not talking about that. Because there are lenders out there, if you've had 3 blips in the last year and the reason for it was just mismanagement and you didn't have the funds to pay, there are lenders out there. You need a huge amount of deposit compared to a 95%.
But they're looking for that kind of...
They're in that market, and that's kind of it. So it's not like Chorley is saying, we want the people that Halifax to get. It's more about, I'd love to see your figures on delinquency and default, because if you're looking at it from a human point of view with experience as an underwriter, you've got a mandate, it is on your head, you're making the decision and you're looking at, this is my type of customer, our type of customer, then actually I'd say you'd probably not have worse than Halifax, who use a scoring system. You would expect.
I think a bigger myth for me would have probably been, in my eyes, I would have more chance going to, as you said, HSBC, Santander, someone like that, who's, you'd imagine they've just got billions and billions and billions, and you'd be able to go there rather than going to a smaller, more homely kind of company. I would expect to be, Chorley would
be pickier.
We're kind of like, I'm kind of thinking like small fish in a big pond in a way. Like with HSBC, it's like, yeah, we've got loads of cash. We could easily, we'll do that. They'll have almost less stringent expectations of what.
I can
do you see what I mean? It's hard. I'm trying to get it, vocalise it right, but it's not.
I think from our point of view, we will judge each case on its own merits.
Which
there'll be times where we say no, of course there will, but there'll be times where we say yes, and someone like the HSBCs of this world will say no. And I suppose when they're creating their automated systems, and I don't know this, so I'm not saying that this is how it works, but they perhaps have to do that calculation based on the worst case scenario,
of course,
the lowest denominator. And actually, those people who fail it, there's still a fair amount of those that are actually really good lending, but just don't fit the mould that they've created.
It's not something I would have still expected to be as... I wouldn't have expected you to have, I wouldn't say an advantage, but to be able to still offer that with the way everything's been and all of the world in turmoil and all that, and the way that things are with them being so big, almost competitors to yourself for lending. It's great that you can still do that and give more of a personal, human element to it, if you see what I mean.
And this is just me speaking from experience, but also as a mortgage broker, I'd be more confident with an accept from Chorley than I would from Halifax, because it said yes, the computer said yes, because once those bank statements hit and things like that, that 999 credit score can still be rejected because of something on there. Okay. With Chorley, we're going for the human touch, we're putting a case together, and actually they've kind of seen the file, they've seen the person, not just the score of the system.
This is the difference with it, isn't it?
And it's and we've seen that in the past when I've put cases to them, and it's an interesting way, but it would be almost impossible for Nationwide to take up that level of human interaction underwriting, because an underwriting a file when I did it back in the days was 45 minutes minimum, and there's pressure on you there because you are that computer to say yes or no, and it's not something you want to be given out lightly, is it, either a yes or a no?
No.
It needs to be a confident one. But on that, Stu, to move away from that, we've been accepted, you've said we're a good customer and we'd like to do business. What other hidden niches, myths, best kept secrets have you guys got? What would blow Barry's mind? Because Barry's building a bank. He wants to be it's Bank of Baz.
Bank of Baz.
So he's going to create a new bank, Bank of Baz. And he's got his own criteria for his bank. What can he steal off you?
Right, okay. Where shall we start with that one then?
Trade secrets.
So we can do, I suppose one of the things that, as a mutual, as a building society, we're all about our customers. The whole ethos of what we do is looking after our customers. It's not the shareholders, it's looking after our customers, because ultimately we are owned by them. So we'll always try and find ways to help more people to get on that property ladder. So we've talked about the 95% and being able to do that sort of thing. You might have situations where affordability is perhaps a bit of a stretch for people. So we can do joint borrower sole proprietor. So joint borrower sole proprietor, you might hear it called a JBSP, and a lot of people won't have heard of it at all.
Nope.
And it's a little bit like a guarantor. So where you've got a son, daughter, or a couple buying a place, but they can't quite make the affordability, the borrowing amount that they need for that property, because let's face it, house prices have gone up. We were talking about it earlier, weren't we? And you go back 20, 25, 30 years, and we'd have been looking at 2.5 times the joint salary, maybe 2.75 if you were lucky. A typical mortgage term was 25 years, and now we're kind of at 40 years, aren't we? And being able to go up to 4.5, 5 times, maybe even times where it can go beyond that with some lenders. And that has got to put a bit of a strain on people. And so if parents can help, then why not? So with a joint borrower sole proprietor, it means that a parent or parents can go on a mortgage with their kids.
So if there was, say, me and my wife, but my dad, for instance, was able to help. We couldn't afford it. My dad was going to help us. Could you, when you say joint, I'm just instantly thinking it's 2 people but it couldn't. It's
so,
more.
So yeah, I mean, I suppose there's another podcast in itself. So we can do 4 applicants, and we can use all 4 incomes.
Oh, okay.
A lot of the big lenders will only do 2, because their computer system won't accommodate more than 2, will it? So we can do 4 applicants. We can use 4 incomes. So there's a different aspect to that. If you were just looking at the couple looking to buy, parents have got their own home, they've probably not got a mortgage on it, they've got their incomes, they can go on the mortgage, but they're not named on the deeds.
Yeah, so it's not, it's literally there as a fallback in effect.
With the kids, but they're helping with the affordability. So they're liable for the debt or part of that.
So
debt.
as they say, like a guarantee, what would I would always have thought would be a sort of guarantee.
You made a good point for the Bank of Baz. It should actually be called multiple borrower. Solar joint proprietor, shouldn't it? Like that, because it's right, isn't it? It's not your joint. You think too.
What's the acronym for that then?
Exactly.
Something.
But so the scenario, to give you a scenario, because I know how your head works. It's
just wait till you hear my next question.
It's potentially, I've just gone self-employed.
Yeah.
Okay, doing really well. I could rent that property at £1,500 a month quite easily because the income's here. It's there. But in terms of a mortgage, that income doesn't exist on paper until I've got a year's, 2 years books. But I know I can afford it, and my parents as well as my partner, with their level of income that they've got, could help me acquire that in terms of a mortgage. So what we're doing is proving it in facts of income equals this amount of borrowing capacity. My income, which isn't allowed to be on the table in paper, is still there. So everyone needs to afford it. We're not saying borrow more than you can afford, because
but you just haven't got the records to show it, so you know that it's never going to affect the people that are on.
So that situation, we could bring in parents if the affordability allowed, to get me somewhere where I would probably think I'm self-employed, can't get a mortgage for 2 years.
And at the end of the day, if it doesn't happen and you didn't perform as well and you didn't make that money, they're going to have to pay it for you, aren't they? They are, aren't they? They've signed up for this. It's not like you're just saying.
I suppose there's different angles you can take on that. So Paddy's right. You could use that scenario, and the parents, because you've not got provable income, the parents have got to be able to cover their own affordability and all of the other one, even though you know that you've got that income coming in to cover it. Another aspect might be that you've got a couple or one person, and they can do the affordability to a certain point, but they're just a little bit short. So it can be covering kind of that amount.
So it doesn't have to cover the whole lot.
Not on a joint borrower sole proprietor. No, if it was a guarantor, it would do. But not on a joint borrower sole proprietor. I'll give you an example of. It's not dissimilar to Paddy's, but it kind of links into some of those things that we talked about before. I had one just recently where somebody's had a marital split. It was the lady wanting to buy a property or take over the existing property. I can't remember, it doesn't really matter. She'd recently gone self-employed. She'd got a credit card, but because of all of the life experience that you have with a marital split, taking the eye for ball on a couple of credit cards, there was a couple of missed payments a few months ago. Dad had helped out reducing that credit card, getting it back up to date. She'd got on track with paying it, so there was a good few months where she'd been paying it on time. But of course, we'd still got that problem where she'd not got the accounts. So, but Dad had his own business, decent income, unencumbered property. He was able to go on as joint borrower sole proprietor. And from an underwriter's point of view, they can take the solace in the fact that while she's not really got an income that we can take into consideration, that income is nonetheless there and will grow over time. Dad can cover it anyway. So either way it was okay, but it just meant that you had a real life view on that, and various different aspects of that would have caused a failed credit score.
Of course, going
back to what we were originally talking about, even the couple of missed payments would have. So it changes that, and I suppose then there's another aspect, isn't there? Because it's kind of touching on that 4 applicants, 4 income and affordability. Sometimes parents and kids want to buy together. Did you want to ask me another question before I go into that one?
Well, it's a bit. It's going to make me look like an idiot. Just before that, would this work for say, me and my wife and father, mother wanted to go in and buy, say, a buy-to-let? Would that could you do that for that kind of thing as well, or is it literally just for a residential?
Do
you know what I mean? Can you have more than, I suppose on a normal mortgage, can you just have more than one couple?
Do you do the joint
mortgage,
borrower sole proprietor on a buy to let?
I don't know the definitive answer. I can't see a reason why not. I probably need to check that. But
I was just thinking out the box there, because
totally.
we've obviously, the dream is to buy a nice place abroad that we could all share, which won't ever happen. But you know what I mean? Something like that. That would be the ideal scenario for me to think about doing that. If you see what I mean, all going in together.
The buy to let sector is a whole completely different. In some instances, you don't need any income to get a buy to let. You just need a bigger deposit.
Right.
You can't.
Yeah, I've gone off on a tangent.
No, I like where you're thinking.
Yeah,
but
I mean, from our point of view, we can do a first-time buyer, first-time landlord, and you've generally got a minimum income threshold, but the calculation is done around the rental income you're getting. So there's probably not that massive a need for a joint borrower sole proprietor in that scenario.
Right,
but if I suppose if you wanted to do it for tax purposes and stamp duty and things like that, as in not go on the title deeds, but have a joint for mortgage to hit that minimum income criteria, then there are lenders out there that would do that.
That's a different one. Shall I ask this really simple question now?
Go back to Stu's point, because this is another reason why you would have the joint borrower sole proprietor.
Yeah.
And it's probably something we're thinking about, everyone's thinking about in the future. That's buying the bigger property with parents.
Yeah, so I suppose the joint borrower sole proprietor is where you've got perhaps a couple buying a place for them to live in, and parents have got their own property somewhere else.
Yep.
But actually there's more and more people looking to have kind of intergenerational mortgages, parents and kids buying together and living together in one property. And one of the myths and challenges that people doing that would have is the age of the eldest applicant, which is quite often dad.
Right, yeah.
It's always dad's fault, isn't it?
Always.
Will dictate the term. So if the term can only go up to somebody's retirement age, if dad's 60, then you probably struggle to get beyond 67, 68, maybe 70, with a lot of lenders, which then massively reduces the term, increases the mortgage payment, which then affects the affordability.
Yeah.
Probably defeats the object of what you're trying to do.
Yeah.
From our point of view, we can actually go beyond normal retirement age for parents, and we can be a bit more flexible in our approach as well. So again, that human touch of understanding the scenario might actually be the perfect way of doing it.
So would you require more affordability from the other people in that little group to cover in case anything did happen, obviously age related, with someone being older? Would you then say
if they died?
Yeah, well, in effect, if you think, say it was 100 grand, and in effect you were looking at, and everyone could afford.
To be honest, that's the same in a joint application with your wife, and it's kind of, that's part of it. You could have a joint mortgage which you could have only afforded, and together, and if one of you were to die, then obviously there's an issue there, and that's a completely separate. It is handled by the bank, and
I'm just trying to get it in my head, as in, like, obviously there's more risk. The older the person this is one of the things we did a kind of mock Bank of Baz, didn't we? If you remember, and you said, what would you ask? What do you think? I can't remember what it was. Was it what would be the riskiest thing that you would be a bit biased against? And I said, well, if someone was coming to me for a loan, I would think, well, if the 80-year-old, there's more chance of them not being here to pay it back. As sad as that sounds, how bad it is. All I'm trying to get in my head is, if someone has that more risk, in effect, of being older, do you then have to think, well,
that mortgage will still be repaid?
Yeah.
Because the property would be sold. That could be a single applicant dying and passing away. Whole new avenue.
Yeah, I mean, Paddy's right. You know, it's not dissimilar to a couple buying, because if you're reliant upon more than either of the people's incomes, then it's absolutely the reason why you should protect it. Nobody says that you have to have life insurance and critical illness cover and income protection, but actually, are you mad not to? Yeah, of course you are. And the only thing that is a must is buildings insurance, and that's dictated by the lender, because the lender That's their security. So ultimately, if the mortgage doesn't get paid, the property gets taken into possession and sold, and the lender gets their money back. That's the harsh reality.
Regardless of the situation. So it does death.
Yeah,
will result
yeah.
in-
So
Yeah,
but
I get
your
it, yeah.
scenario, if you've got, I suppose there's two kind of aspects to this, isn't there? So you could have 4 friends buying together, all of comparable ages, and they're just buying together to boost affordability and be able to buy somewhere a bit bigger. That carries the same description as Paddy was saying. If you've got parents and kids, then you're right. So a couple of them are going to be, typically at least 20 years older, aren't they? So there is that life expectancy element that might come into it. From our point of view, we can do a repayment mortgage up to age 90, and we can do interest only up to age 85. There's obviously different parameters to that, and we'll cover that on a different...
Sorry, to explain that means if I come to you at 60, you would be able to possibly give me a 30-year term.
If you've got the affordability, and if it makes sense to, yeah. But, going into your retirement
that's
years,
crazy, that,
then
isn't
we
it?
may look at your pension provisions and projected pension. Or we could even do it if you were actually already retired. But we would be looking at your pension to make sure that the affordability is there to pay it. Now, none of us know. I mean, I could leave here and get hit by a bus.
Yeah,
So,
no, I totally get that.
Our life expectancy, but we do know that mortality rates are
Yeah,
going to change the older that we get. Cause
this is the thing. Like, I'd be thinking it's all right saying you could, like, if I was signing up for a mortgage now, you have to declare any medical conditions and things like that. But and I'm not a doctor. I'm not a doctor.
Not for a mortgage, you don't.
Do you not?
No, for life insurance.
Why are you asking me all those questions?
That's just
So,
nosy.
all right, okay. So I'm probably confusing it with that. But you would think you don't. As you get older, obviously, you're going to end up with more chance of getting something wrong with you. This sounds really bad, but you know what I mean.
You're selling life insurance to everybody.
I'm just
It's
worried
brilliant.
that like, as Bank of Baz here, I'm in your seat here. I'm worried that the chances of something happening to someone between 60 and 90.
Oh, Baz, you couldn't even, by the sounds of your Bank of Baz, you couldn't even, if someone stopped paying for 6 months, technically you can repossess the property, turn up and take the keys. You wouldn't do that because you're too nice.
No, I think I would because I'd be.
No, you wouldn't.
I'd be terrified that I'm never going to get my money back.
Stu,
the only thing
yeah,
that's
so I think the reality of it is if you actually assess it, in a lot of cases, you'll find that parents have accrued a wealth, haven't they? They've accrued equity in properties and savings, and they're putting that into the property. Now, the kids have probably got the affordability on the mortgage covered from their own incomes, and you don't really need the parents.
Yeah, it's just on the paper, isn't it, then I suppose.
Yeah, but because they're putting all their money into the property, they're going to be named on the deeds, and then naturally they'll have to be named on the mortgage. But you can be a bit more, at the end of the day, it boils down to Paddy's advice.
I totally get that.
Is this a sensible thing to do?
I mean, the parents are going to have their own property with equity. Potentially, if they've got an income in a retirement, they've got a pension, which has a value. So there's things, as well as life insurance, which obviously not everybody can get. And it's one of these things where we don't just, as an advisor, recommend. It's almost on our head be it. If we believe that, would we lend them the money and would we be trust that they could get it back? There's always those parameters that could come into play, that illness, things like that. You've got to take that risk. No one's perfect.
I take it there's a risk from your side then. If you're recommending people all the time,
we've got to do our job right. We've got to be sensible. We've got to treat them fairly. We've got to be.
If you have a lot of people default with the same, so with Chorley, say there's a lot of people that Paddy had recommended, said, "Oh, they'll be fine. Yeah, we'll go ahead with it." And if a lot of those default, does that look bad?
It is monitored, yeah. Absolutely. So it should be, but it comes down to you do 100 mortgages, everyone should be on the same level because it just comes down to the background stats, doesn't it? But just going on to, because the joint borrow thing was brilliant with you guys. You do the self-build. Can you have the joint borrow sole proprietor on the self-build side of things?
Yes.
Wow.
Right.
So,
Easy answer.
That's brilliant. You know why I'm going to take on this one just very quickly?
Yeah, go for it.
You're professional or you're self-employed or you're building your business and you're thinking, rather than settle for that home and then upgrade in 2 years' time, and then you could actually look at something that you could do and bring in the wealth of parents to enable you to do that. And in 2 years' time, when you put that onto a residential exit, you may be in the position to have that on your own anyway, because your income's gone up. You're a doctor. You're in a position where you're in the military. You've had a promotion, and it might just be at the time of it. And it also would, am I right, give you an extra buffer for the costs that might spiral in a term of your amount that you're able to go to for the build. If you've got the parents.
There's several different bits in there. I'm trying to decide which bit.
This is
But
another
what, do you know what I mean?
podcast.
If I knew I was building a house and my capacity for me and my wife was £200,000 and I'd estimated my costs at 170 and I built in that buffer we were talking about with Tom, just knowing that if your parents were on there, that you had the ability to go to a high level to finish the job, so the grand designs scenario, then that would be a massive peace of mind for a self-build.
Yeah, so I suppose there's different aspects to that. So the joint borrow sole proprietor bit to help with affordability would probably be done on the amount that you're looking to buy, and you probably wouldn't really go into it thinking I might run out of money and get beyond that. And I think probably the podcast before this is with Build Loan, isn't it?
Yeah.
So one of the things that we do, our self-build products are done with Build Loan as well, and the whole mechanism is to help mitigate risk. Let's face it, we've all watched grand designs, we all see all of the problems that can happen.
Yeah.
We've all seen people run out of money, max out on credit cards, have personal loan, the guy looks like death on legs because he's living in a cold caravan, he's added a baby to his life. Why would you do it at that time? His builders have disappeared off site because they've not been paid. And he knows that if he gets to a certain point, the lender will lend him some more money. It's already been agreed, but he just can't get to it. Or actually, they've just blown the budget and they've run out of money completely, and then they've got a world of problems to sort out halfway through a build. So what we do, with Build Loan's help, is to mitigate a lot of those risks. So a lot of it is, what are you building? What are you building out of? Where are you going to live during the build? What available funds have you got? What's your cash flow requirements? Because different construction types will dictate different cash flow requirements. And really importantly, spending a bit more time at the front end with the costings. Because let's face it, any of us, whether it's somebody doing a self-build, whether it's a mortgage advisor or an underwriter, will look at plans and estimates and we'll all go, yeah, they look all right to me. Because we're not building experts, we're not quantity surveyors. So how would we know anything otherwise? So what Build Loan help us to do is to get those costings verified, make sure they're realistic and achievable, be able to tailor cash flows around what people are building to mitigate as much of that risk as we can. We have cost-based lending so they get the right amount of money at the right time. And ultimately doing that costing project at the front end should mean that potential for needing to borrow a bit more at the end is removed, because if everybody sticks to the plan and the costings that they've done, you're absolutely right, you're building a contingency, because there's always going to be, if you've got, there's probably 200 plus buying decisions that you have during a self-build project, so it only needs one or two of those to go a little bit off piste and you've got an extra cost. So having a contingency in there is really important. But it should all still come in with that budget. But I suppose if in the unlikely event of it going outside of budget for some other reason, then there's that potential that the parents could be
I just
helping
the
with that
amount
affordability.
Interesting.
especially the people that do it. It's always it always impacts on your work. So the likelihood of you continuing to do your overtime, the likelihood of you continuing as a self-employed person to even make a profit or bigger profit in those years whilst you're going home on an evening and working on your property, the real self-builder. I think having that, rather than trying to, this is the maximum you can get, and you cutting corners on the build, that you can afford it.
It's like another buffer.
By having that to get it, I think that's a great thing. It's something I've never, again, like this self-build podcast, I just think it's a massive eye-opener.
We've had the wave from Susie Dent.
We have.
We're coming to the end of it. So
we've got three questions.
Well, first of all, I just want to cement my ignorance, really. I've had a few looks from Stu, baffled about the questions I've asked so far. Not as many looks as Paddy got there in that last one, but no, I feel bad enough when I'm just in a room with Paddy and he's not the brightest. But this is horrendous. What's the difference between a building society and a bank? First of all, you were saying earlier, you touched on it, how you're not answering to shareholders, you're answering to...
Yeah, so a building society is mutual. It's owned by its customers, and it's all about, for us in particular. Well, no, not just in particular. For us, it's all about community. It's all about helping people, helping people onto the property ladder, helping people to buy, and taking that, that personal approach to lending, instead of it just being computer says yes, computer says no. And it's not all about profit. It's about looking after people.
So, with that in mind, then, because it's based around the same process, isn't it? Of people give you their money to look after, and because of that, you can then lend money to other people. So the main difference is there's not people at the top, kind of.
Well, yeah, I mean, we've still got.
You'll still have
directors.
Yeah, directors and things like that, but it's
board members.
But it's more customer focused and community focused.
It's not all about profit. With a bank, it will absolutely be about profit, and of course we've got to make a profit.
You couldn't keep going.
Nobody would stay in business if you didn't. But our motives are.
So is that the main benefit? Is what I was getting round to? The main benefit of being with a building society is that personal touch and that the community kind of ethos behind it, in effect.
Yeah, I would say so.
And it doesn't necessarily mean that they're tiny either, because Nationwide's a building society.
That's what I think of straight away.
And they're huge.
Yeah.
But no, like where we live, a building society is so attractive for the core values that you've got.
But this is it. I mean, I grew up in Sunderland, and it seemed to be banks rather than buildings. I mean, Nationwide will have been there, but was it just called Nationwide? Or was it Nationwide Bank? Or was
it's
it
in the name, isn't it?
Yeah, but was it always as branded as that? Because that...
Yeah.
I'd
building
societies... shows how
societies...
naive I am.
I mean, we've talked about self-build. Building societies were set up to build societies, as the name suggested. So it was almost like... I think Nationwide actually had an advert on it, where people would put their money into a central
pot, in effect, yeah.
Help build somebody's house, and then that pot would move around to help build the next house. And originally it would be a group, and then once they'd all done, it would close. But obviously over time they grew into
something that's there as a resource, yeah.
And a good few years ago, a lot of them got gobbled up by banks, but they've very much found their feet now and do the things that the big banks either can't, don't, or don't want to do, because of those things that we've talked about.
I think it's more of an attractive proposition as well, the way the world is now. You want that human interaction, you want that sort of face-to-face in effect, rather than...
And ironically, it's what's not happening, We've lost HSBC in town, and it's for the people of the in Appleby who've relied on it. It was ridiculous.
There's nothing more frustrating, though, is it? Even if you want to talk about something, you want to talk to someone.
Yeah, I mean, it's a generational thing. But I think it'll continue in terms of it won't make a difference. Sometimes it is better to... We've got customers at 18, 19 who want to prefer to come in and sit with us face to face, because you need to... Some people just work better with people, and I think why not? And that'll never change. But the high street banks, the big banks, are probably looking at more profitability as opposed to keeping your branch.
Yeah, it's understandable.
I think what you've just described is quite poignant. From our point of view, we're in a little building society and we have our branches, but those branches are inherent in what we do. We know that people like coming in, and as being an in-depth part of the community, aside of the mortgages that we've been talking about, some people will come in and our counter people might be the only people that I've spoken to all day, and they'll take the time to have the conversation and with them, and it doesn't really matter how long they're there, because we're there to look after them.
Yeah.
We're there to look after the money, and ultimately what you described was we take savings in and we lend it to people, and that's how any building society will work. But it's about the community. It's about looking after people. Just
my question, because I get one on these ones now. We've got a
guest. Go on.
My question is, I understand the setup at Penrith because I've spoken to them, and there is some instances where we'll put a case to the building society, and it's 50-50. It's one of these where it's got a few quirks to it, or as we call pillars missing. but it's a really strong case, but it's not quite our criteria. It's not quite met the lending. And they would actually have a meeting with the committee and the board and say, can we lend your money, our money, to this particular person, which is a bit like the passing it around your community. Is that how you guys would work as well?
Yeah,
are you
so
that close to the top directors?
Absolutely. Yeah, so we are a relatively small team. So again, if you're looking at one of the big lenders, there would be thousands of people from our point of view. There isn't, and we have a what's called a credit committee. So probably what you're describing with the Penrith, that meet on a daily basis. So those things that are good lending, but they don't quite meet lending policy. But the underwriter is backing it and saying this is good lending, but I think we should be doing this. They can go and have that discussion with senior managers and executives to get that signed off, or not. It doesn't always work, but that's what they'll try to do. I suppose one of the things just to touch on it, we obviously talked about credit scores and blips on credit profiles. We're not an impaired lender, so we'll do things from that are life events and probably a little bit more historic, but there are lenders that will do things more recent that Paddy would find. So don't think that everything's going to come to us just because it's a low score, because it's not adverse. It's about lots of different factors.
That kind of leads me on, and obviously
I'm looking forward to this last one. Come on, Barry.
Thank you.
It's been great.
I was
Do
just
we need drums for this?
I've got some in the back of the car.
He's a drummer. Oh, look at that. Yeah.
Look at that.
Stu's done his research.
Yeah, so that's worrying, isn't it? What are the three, I've put biggest, most important things that you're looking for when you're lending money then? If that's if there isn't a credit score in place in effect, what are the three? Doesn't even have to be most important. What's the most valuable things that you think you're looking for then? Or one, if it's too hard to give us three.
I think with any case, it's a combination of things.
So it's individual on every case in effect.
Yeah, absolutely. Yeah. So affordability's got to be there. At the end of the day, there's an old joke. I don't know whether I should share it with you.
Yeah, go on. Safe space.
A couple of fellas living in that are in a pub, and one of them says, "Oh, I see one of these other countries has got a weapon that can go into buildings and kill all human life and leave the building intact." And the other guy says, "We've had that for years. It's called a mortgage." Now, there's kind of a point message to that, and that is, if Paddy doesn't do his job right, if we don't do our job right, then we can absolutely destroy lives. But if we do it right, we enhance lives and we help people get on a property ladder and live a lovely life and own their own property. So, there's two edges to that sword. So affordability is one of the most crucial elements. And credit worthiness doesn't mean credit score, does it? So if people are not paying things just because they can't be bothered, and they don't feel it's important, then they're not creditworthy, and it'll still be a no. But just because you haven't got credit doesn't mean you're not creditworthy.
No.
Yeah, and to touch on that, what another thing Martin Lewis says, and he gives tips and tricks to mortgages, and what he says is, if your maximum lend is £90,000, if you borrow 89,900, the computer will see that you're not borrowing to your maximum, and that's an algorithm. And he mentioned it in his mortgage special.
And is that a negative or plus?
What he's saying is that if you're at your maximum spend, and that's what you're doing, so that could be a percentage or could be the amount, that would be, the computer says yes.
Okay.
And it more attractive yes, because you're not going up to
madness.
And I know lenders that will, if you put it at 94%, you'd have more chance at 90 than 95, and that could be pittance.
So such a small
but the good
percentage,
thing for Chorley, the good thing for Chorley is they'll see that. They'll see all the things that you're trying to get past by just ticking boxes. And when that case hits you, that 94% or 95 will make no difference to your lending decision in a good way for you as a bank, but for the customer, not trying to just to play the system.
So it kind of goes back to what you were saying before about what's the difference between a credit score and a credit search and a manual underwrite, does that carry more risk? Actually, it doesn't, because we you know, what Paddy's just described is a mechanism that you reduce the loan amount, it enhances what you can borrow, but actually the monthly payment is going to be what, a few pence different probably, and if it's that much different. But does it make it more affordable? It doesn't really, does it? So you've got to assess the whole
it's crazy how much
responsible borrowing would still be there from a building society point of view, because you're looking at it as a human. But there is ways to build up your credit score and get that 95% pass with the Halifax, and that's just by ticking these boxes. And luckily, most lenders, especially at 95%, it would involve a human underwriter and someone to jump in, and that's always going to be important. But the beauty of using a mortgage broker is that we're kind of the first sounding board to say, is it right for this customer to have a mortgage at this point in their lives? So I
think that it's made me reevaluate the Bank of Baz terms, the ageist thing, no one over a certain age having a mortgage. So I think I'm going to have to change the...
But the real question, which you can get back to us when we have our next podcast, is, are you going to be a bank or a building society? That's your homework.
Building society. I'll answer you now.
Stu, it's
been really good, that, thank you. Sorry for my ignorance, but it's been great.
It's really good. And I think it is a disservice to yourselves and the Chorley. There's so many quirks, or as we called when we last met at the event at North Lakes, your best kept secrets. And I think there's room for, just like Build Loan wanting to come back in.
Myriad of podcasts, isn't there?
We can have many more myths to bust.
Absolutely.
And I think that's the beauty of the building society, is that you do things that others wouldn't. Yeah. And I think that needs to stay in the market. That's how you help people get on the ladder. Not with all these government schemes. We need true real life underwriting who understand that life events happen.
Yeah, definitely. I think the personal touch is something
that was the myth. We've busted it.
Yeah, if you need any design work doing, becreativecompany.co.uk, we always get that in.
Yeah, you're getting it in at the end though. Now it used to be.
I know. I need to slip it into the conversation.
People might have switched off now, knowing that we're.
I actually listen to the guests though. Usually when it's just me and you do, and I don't bother listening, so I just chuck it in willy nilly a few times.
So that was the myth.
No, it's been really good. Really good. Enjoyed it.
You need.
I've really
good.
Enjoyed it.
I hope so.
Thank you guys for letting me come on.
Well, it was interesting because we changed the myth, and the original myth was going to be, if it doesn't fit the lender's criteria, give up. And I think we've kind of busted that one as well.
That is kind of what we've gone through, isn't it, really?
And people do that, and that's the sad thing, is people will not get a mortgage because they've been told no by a computer or the bank, and they might have tried a couple of others and get disheartened. If you speak to an advisor who can think, well, actually, that's one for the Chorley, and that's where the value is for us, or direct, but a building society, and there's many of them, each to their own. There's normally a lender for everybody somewhere. Maybe it's not today, it might be 6 months down the line or 12, but that's where we can get to. And that's the beauty of it all. So, Stu, it's been an absolute pleasure.
Yeah,
thank you.
Great, thank you very much.
No worries. Right, till next time. See you later.